For more on the M&A pipeline and the IPO market, let's bring in Stephan Feldgoise. He is co-head of global M&A at Goldman Sachs. And I mean, is it back? Can we finally say that, Stephan? We've been waiting for Godot.
I think waiting for Godot is a good way to describe it. So one, thanks for having me on. I think that if 2021 was a 10 on the M&A scale, 2023 was a 2. Feels like right now we're at a 3 or a 4. In 2023, there were almost no transactions over $10 billion in the first month of the year, month and a half. We've had numerous this year. That being said, the overall deal count is still relatively tepid. And so I think it's a hard call. That being said, we all talked about green shoots last year. When we roll into this year, you think about interest rates and the interest rate cycle coming down. We can all debate when that's going to happen. But that's certainly providing fuel to the fire. I think the big debate, and frankly, we've been debating a lot of the things you all were talking about around technology and impact. What does that look like? Onshoring. I think the big debate is private equity. And private equity was 40% of the M&A market in 2021. It is still waiting largely on the sidelines, both to monetize as well as to look at new investments, looking carefully. But that's really the big barometer.
And both sides of the transactions are attractive now, buyers and sellers? I guess it's always that way.
It's always that way, but a lot of folks sat in boardrooms over the last year and said, my earnings are good, my demand is good. That's a little bit different depending on what geography you go to around the world. Why should my business be worth less just because interest rates have moved up? And so the fingers really just did not meet in terms of where buyers were. We were looking at more expensive capital, and sellers who are saying my business is still very good. Now, a lot of that hasn't changed. That being said, with the interest rate cycle changing, and a lot of boards are looking at their prospects and saying certain pieces of inflation haven't changed. You look at wage inflation, you look at certain dimensions there. And the big change, though, is that a lot of people were able to get core demand growth as well as pricing over the last couple of years. Right now, getting pricing is getting harder as inflation is coming down. So folks are thinking a little bit more conservatively about their businesses in the boardrooms, and so those fingers feel like they're getting closer.
Yeah.
Well, here's the thing that I was going to ask you, which is when you see more M&A activity, there is an argument to be made that people do deals, oddly enough, when they're the most confident, which is oftentimes the worst time to actually be doing it. Meaning they should have been doing it when they were the least confident. And that it often spells the end of a cycle, not the beginning of one.
Look, I think there's two sides to that. There's no question that confidence, CEO confidence, board confidence is the number one driver of M&A. But if you look at some of the dynamics, coming out of COVID, it was strategic repositioning for supply chains and geographic diversification and finding growth. Now you have some extraordinarily well-capitalized companies, let's just take the pharmaceutical sector, who are looking at incredible innovation, whether it be weight loss or other molecules. And so accumulating those molecules to drive growth certainly takes confidence, but when you look at some of the dynamics, whether it be in technology and healthcare, investing into those cycles makes a ton of sense. And so there's really different sides of it. And then you have kind of the classic consolidation where folks are looking for synergies to drive earnings in some lower growth sectors. But it is, as you say, it does come back to CEO confidence. And I would say sitting in many, many boardrooms, CEO confidence, board confidence about the forward, particularly with some of the growth we talk about AI and in technology, that confidence is certainly growing.
Stephan, if you had to, once again, it's going to be some of each, I guess, but is the real opportunity this year going to be in rationalization and defensive sort of plays? Or, I mean, with AI and all the potential and with the cloud, whatever you want to, talk about it, is it playing offense or defense for M&A and PE?
I think it's both. Certainly for PE, they're facing a lot of pressure on monetizations and returning capital. So there's pressure there in terms of rationalizing portfolios, returning capital, and then investing incremental capital. In technology, it's growth into new sectors and new domains. And it's not just tech doing technology transactions. It's industrial tech, it's consumer tech. And AI is changing a lot of that. And as you have these dislocations about how people think about the forward, people are placing growth bets, placing opportunity bets as they look forward. Other sectors, let's take energy as an example, has seen the greatest consolidation we've seen in several decades in energy that started in the third and fourth quarter of last year and continues through today. It is accumulating molecules, accumulating scale, and also looking for growth in attractive basins. So I think it really depends on the sector. But it's a combination of strategic repositioning, combination of growth, as well as a combination in some sectors of being defensive and looking for scale. Because scale still, when you think about credit, when you think about ratings, when you think about just defensive positioning, when there is a lot of uncertainty and volatility, scale matters. And a lot of folks are thinking it from a defensive perspective as well.